As the U.S. and China adjust tariff measures and American importers increase container shipping orders, U.S. analysts predict that this year's peak season for U.S. China container shipping may arrive earlier than usual. Seroka, executive director of the Port of Los Angeles, has noted that with the U.S. still imposing a 30% tariff on Chinese goods, some importers of low-margin products may continue to adopt a wait-and-see approach.
The impact of the U.S. government's excessive tariffs is continuing to worsen. The decline in exports is related to a decrease in the containers ships bound for the United States, as some companies were forced to cancel manufacturing orders, causing some ships to stop entering into the United States. This dual pressure of increased costs and reduced orders further worsen the downwards trend in exports.
Ongoing uncertainty stemming from U.S. tariff policies continues to cause anxiety among port workers and small business owners. Analysts point out that following the U.S. announcement of widespread tariff adjustments, a sharp drop in U.S. China container shipping bookings prompted shipping companies to divert vessels to other routes. To quickly switch back to U.S. China routes, these shipping lines will now face increased costs in the short term.
Any unforeseen demand or supply disruption could affect retailers' supply and prices of goods in the United States. Kip Lotte, executive director of the Southern California Maritime Exchange, has warned that a decrease in the number of cargo ships and containers arriving in the United States will lead to overcapacity in labor, trucks, trains, and other aspects of the supply chain. Due to the reduction in the amount of the goods arriving, they will be unemployed. The data released by the U.S. Bureau of the Labor Statistics on the 2nd of this month showed that non-farm payroll employees in the United States increased by 177,000 in April, far exceeding market expectations of 138,000. There are still signs of economic weaknesses in the non-farm payroll data for April. For example, the average hourly wage in April only increased by 0.2% month on month, which is the lowest monthly increase since 2023. We pointed out that the slowdown in wage rate growth is a sign that the labor market has cooled it down.
Employment and inflation data often have a lag. The uncertainty caused by U.S. tariff policies has already disrupted supply chain stability, and the full impact of these tariff shocks is expected to gradually materialize in the coming months.
I believe that the tariff policies will cause harm to the economy. I suggest that people that not be overly optimistic about these numbers. In the long run, this could weaken the U.S. economy growth, as job losses in export-driven sectors ripple through the economy. Addressing through these challenges requires careful consideration of trade policies that balance protecting domestic industries while fostering a competitive